Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies, Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th Sem students of Bangalore North University. In this session, we are going to deal with the subject called Investment Management. The topic for the session 33 is Arbitrage Pricing Theory. Before going to discuss about arbitrage pricing theory, let us know which concept that we discussed in the previous class. In the previous class, we have discussed about the concepts of capital asset portfolio model as a continued part has been discussed. The learning objective of the chapter is to understand the portfolio management framework and apply the various theories of portfolio management in designing a portfolio. The students will be able to discuss the equilibrium risk returns relationship according to arbitrage pricing theory. The arbitrage pricing theory is a well-known method of estimating the price of an asset. The theory assumes an asset's return is dependent on various macroeconomic, market and security specific factors. Finance arbitrage pricing theory is a general theory of asset pricing that holds that the expected return of a financial asset can be modeled as a linear function of various macroeconomic factors or theoretical market indices, where sensitivity to changes in each factor is represented by a factor-specific beta coefficient. The model-derived rate of return will then be used to price the asset correctly. The asset price should equal the expected end of period price discounted at the rate implied by the model. If the price diverges, arbitrage should bring it back into line. The arbitrage refers to buying in the low-priced market and selling in the high-priced one to gain from price differences for bringing about equilibrium in the market price of a security. The buying and selling activities of the arbitrager eliminates the profit margin and thus bringing the market price to the equilibrium level. The assumptions of arbitrage pricing theory is the investors have homogeneous expectations. The investors are risk averse and utility maximizers. A perfect competition prevails in the market and there is no transaction cost. The security returns are generated according to factor model. Risk return analysis is not the basis. The arbitrage pricing theory model returns of the security are influenced by a number of macroeconomic factors which explains the risk or risk premium relationship of a particular security. The objective of security analysis is to identify these factors in the economy and the sensitiveness of security return to movements in these factors. The arbitrage pricing theory or model, which was developed by Stephen Rose, has given a 4-factor model which explains the risk risk premium relationship of a particular security, what I am going to explain in the slide. Calculating the expected rate of return of an asset using arbitrage pricing theory. Arbitrage pricing theory formula, that is Ex is equal to Rf plus B1 into factor 1 plus B2 into factor 2 plus like that it will be keep on going, where Ex is equal to expected rate of return on the risky asset, Rf is equal to risk-free interest rate or the interest rate that is expected from a risk-free asset, most commonly used in US Treasury bills for the US. B is equal to sensitivity of the stock with respect to the factor also referred to as beta factor 1, 2, 3, like that it goes. N is equal to risk premium associated with respective factor. As the formula shows, the expected return on the asset stock is a form of linear regression taking into consideration many factors that can affect the price of the asset and the degree to which it can affect it. Either the asset sensitivity to those factors. If one is able to identify a single factor which singly affects the price, the CAPM model shall be sufficient. If there is more than one factor affecting the price of the asset, one will have to work with a two-factor model or a multi-factor model depending on the number of factors that affects the stock price movement of the company. The model has been developed by Roos using a notion that security returns are not based on one single factors index of the market. Instead, each security is linked with multiple factors and returns get influenced by these factors. APT, that is arbitrage pricing theory, believes that the return generating process of a particular security or portfolio does not get influenced by its association with the market portfolio. Rather, it is influenced by several logical factors. Gross domestic products, GDP, national income, personal disposable income, inflation, interest rate, consumer price index, wholesale price index, bank rates, foreign exchange rate, etc. Arbitrage pricing theory also emphasizes the fundamental of one single price, which implies that market remains in equilibrium and two identical securities having same degree of risk will command the same price. Either will have the same return on the market in the long run. However, due to short-term equilibrium, there may be difference in the return of two securities with the same risk level, which will attract the process of arbitrage and investors will be able to generate safe returns. Arbitrage pricing theory is one of the modern portfolio theories which is based on the rational behavior of investors. Theory is of one price option, which implies that two differential securities with same level of risk must have same return. If due to certain imperfection in the market these offers different returns, then investors would sell the security with low return and buy the one with high return. Arbitrage pricing theory has two basic outcomes. It helps in assigning price to securities by identifying the securities portfolios as underpriced, overpriced, efficiently priced. It also focuses on the fact that returns for a particular share is derived from its association with multiple factors, either more than one factors affecting the performance of the company. This association of an individual share portfolio with different factors is established with the help of a sensitivity factor called beta. In single index model and CAPM, each share has only one beta, showing the relationship of returns of the share with the index of the market or market portfolio. But in average arbitrage pricing theory, there are more than one beta value for a particular share. Return of a share with each of the factors are shown with the help of a share separate beta value. For example, a share is affected by 7 factors, then it will have 7 beta values, each showing relationship of the returns of the share with the factors separately due to the relationship with many factors. It is called multiple factor model. Let us understand the assumption one more time. Arbitrage pricing theory is based upon certain assumptions. If these assumptions are found valid, then the findings and the logic of the model are applicable. The investors are risk averse and utility maximizers. That is one assumption. The second assumption, investors have homogeneous beliefs. And third one is markets are perfect. Fourth one is multi-factors effects. Fifth one is dominance principle. Sixth one is equilibrium of the market. And then efficient frontier. Here, the arbitrage pricing theory is a multiple factor asset pricing model based on the idea that an asset's returns can be predicted using the linear relationship between the asset's expected return and a number of macroeconomic variables that capture systematic risk. Dear students, let us understand some of the concepts through the multiple choice questions. We have first question to make this arbitrage, that is arbitrage pricing theory, more sensible. Arbitrage pricing theory is a well-known method of estimating the dash. We have option A, price of a product, option B, price of an asset, option C, price of service, option D, price of delivery. Any guessing answer for this? The answer is answer price of an asset. Here, arbitrage pricing theory is a well-known method of estimating the price of an asset. Similarly, we have another question. The buying and selling activities of the arbitrager reduces and eliminates the profit margin and thus bringing the market price to the dash. Option A, average level. Option B, low level. Option C, high level. Option D, equilibrium level. Any guessing answer? The answer is option D, equilibrium level. Similarly, we have another question. Returns of the security are influenced by a number of dash which explains the risk or risk premium relationship of a particular security. We have 4 options to answer. Option A, marketing factors. Option B, microeconomic factors. Option C, macroeconomic factors. Option D, environmental factors. Any guessing answer? The answer is option C, macroeconomic factors. Similarly, we have one more question. As per the formula of arbitrage pricing theory, the dash on the asset or stock is a form of linear regression taking into consideration many factors that can affect the price of the asset and the degree to which it can affect it, either the asset's sensitivity to those factors. We have 4 options. Option A, regular return. Option B, expected return. Option C, changing return. Option D, decreased return. Any guessing answer for this? Option B is the right answer, expected return. Similarly, we have one more question. Investors have dash is one of the assumptions of arbitrage pricing theory. We have four options to fill this filling the blanks. Option A, homogeneous expectations. Option B, heterogeneous expectations. Option C, fluctuating expectations. Option D, high expectations. Any guessing answer? Here the answer is option A, homogeneous expectations. Dear students, we have several references to understand this arbitrage pricing theory in detail. The books for references have been listed and which is displayed in the slide. I request all of you to go through these references to understand the arbitrage pricing theory in detail. I wish you all the best and good luck for all of you, and thank you for your patience listening. Thank you one and all.